Hello everyone, Andy here. Today we're going to analyze the company BAYER for you. Let's just get right into the analysis. We have a couple of very interesting news coming out of BAYER. In a bid to claw back $2.15 billion in costs, the chief executive of struggling pharmaceutical giant BAYER announced in early April that the company was eliminating middle managers and allowing nearly 100,000 employees to self-manage under a new model dubbed dynamic shared ownership. In the process, it's also ripping up 99% of the company's 1,362-page corporate handbook. I think we should see that, first of all, as a great news for a company. As you know, German companies, they are very conservative with cash flow. I will show you very soon within the next slides why the free cash flow is so important for such a company. They're very conservative about cash flow and free cash flow. Moreover to that, as you know, German companies are very bureaucracy oriented. There are two certain things that, in my opinion, would hurt companies in Germany. One is definitely bureaucracy and paperwork that they have to do in complete in order to meet the regulation standards. Number two is definitely the unions, and I'm going to talk about the unions, why basically they are stopping BAYER to grow. BAYER is worth a quarter of its 122 billion peak from 9 years ago, and the shares have tanked by more than 50%. So the company is in shambles right now. However, one of the key elements that they have done is cutting down on their dividends, which is a great decision. One of the key problems is that two of their patents are basically expiring in 2 years' time. That's one problem. The second problem, as I mentioned, is that the workers' union, guys, crazy in Germany. In any case, it's a very really a high-risk strategy for BAYER. The union has the opposition to a sale of the consumer healthcare business and is blocking prospects, and also to the growth slump it has been experiencing for the past 10 years. The other problem remains, of course, the glyphosate-related losses in the United States. Uncertainty on this subject is still at a maximum for BAYER, and it's also worth noting that it has set aside 6 billion euros in provisions to cover this, added to the 11 billion euros which they already spent in 2020, and this fairly seems to be a substantial safety cushion for BAYER. So at least as far as the cash flow is concerned, they're doing okay. Cutting the dividend and suspending bonuses have saved the company 3.5 billion euros, guys. All right, having said that, so let's get down to the fundamental analysis of the company. Look at here, guys. The balance sheet is a mess. As you can see, the revenue, $47 billion, cost of revenue, and expenses are, the cost of revenue is quite under control. Expenses are not, and therefore the earning is in a very bad position right now. We're talking about a negative 6% of profit margin. We are burning cash, guys. Add to that the price target decrease by different analysts, as you can see here, 1 to 42, 51, 57. Citi, I believe, also reduced their price target to 30 euros, which is as low as it gets right now. However, their earning growth rate is quite okay. We have to wait, I believe, for their earnings to be out on May the 14th. And as far as their debt to equity relationship is concerned, as you can see, the story is not really good. But if you look at the ratio, 132% debt to equity ratio is not considered really terrible for the company. So far the news is just horrible. On the first look, you see some very interesting development. Now, if you look at the big chart, guys, the company is an absolute mess. But what do you know? We see a clear support line right here, guys. Basically, it could mean that the company is going for a finding a bottom line and then potentially building on it. The story gets more interesting as this gap, guys, this gap right here has been now filled up, and that means now we are basically getting ready to cover this point, this gap that was already a big sell-off, to cover it up and potentially build upon it. Our stochastics are on our side positive, so I believe if we can actually pass through the second pivot points. Right now we're fighting with the first pivot point, which I think it shouldn't be too difficult for them if the numbers they publish would not totally disappoint. I believe we have an ascending triangle here. That's a great depiction for the company trying to go for a bullish run. Now, our immediate point of concern is definitely this point, guys, right here. We want to see a clear passage of basically to a 28.92 mark, and once we get over that, the chances of the company going to fill up this sort of square is very, very high. Then the field is open for the 35 limits. Would I invest in the company in a short term? You would be surprised. Yes, I would buy the company on a short term basis. Long term, however, guys, they have a lot to correct and a lot to show. Therefore, I'm not a long term, at this point in time, a long term investor of the company. I will be at best a trader of the company within a certain range, the 25 point being my bottom line, and then trading at 428 first step, second step 35. If they can establish themselves around that mark, perhaps you could stay with the company. Thank you so much for following me, and thank you again for those who put comments and always give me new ideas and new companies to analyze. Talk to you in the next video, guys. Thank you, and bye-bye.